Hey guys, welcome to this video. Will Sebastian here. Get my free training underneath. It's right there to be taken. So I'm going to talk about the Swiss yen, how to trade it, how I trade it, and everything like that. If you just open up a chart, I'm using TradingView for this. The link's underneath. You can see we go back to 1971, at which point you were way up here. Okay, 4.3 Swiss francs per US dollar. What's happened since is a big devalue of the dollar against the Swiss franc. You can see the value has dropped and dropped and dropped and dropped. Now, obviously, Switzerland has a strong economy. They're a very prominent country and economic zone, really. And you can see for the very long term, you've come down and down and down and down and down and down. So that affects the decisions you make now. And I'm going to go over the reasons why that is. You can see if I just draw it out here, you've more or less followed a fairly harsh downtrend trajectory, I would say. And since the point of about 2013, you've only really gone sideways. So if you traded this market sideways since 2013, or in fact earlier in 2011, just as we came out of the financial crisis, you would have done quite well just buying at support and selling at resistance while the market moves sideways. And there's a lot to be said for that, really, because you could have, like I said, practically made an income just trading that way. So really the basis for how I'm looking at it and how I would trade it now is much of the same, okay, because you've proven that the market has just gone sideways within this range, okay? It hasn't really gone below 0.83 since 2015, okay? So it's mainly stuck between about 0.86 to about 1.01, okay, for a very long time. Now, anything to the upside obviously is going to constitute a short, because you've seen it short so many times before and it's a key price action level, okay? And if you look underneath, you can see that, well, firstly, what we've really got at this point is a pop-up from here, but you haven't come very far, and you've come back to this amalgamation of key moving averages very early on, in line with all this resistance here, okay? So I really wouldn't be surprised if you do retry that level, but anything back down here is still a long, because it goes in line with a consistent market value over time. Okay, only really the lowest being about 0.833. So you've got your clear market gauge, and professional traders or the larger money in the market know that very well. They're fully aware of where traders are going to be short, where they're going to be long, and where the real market value is. Because if you look at the top here, this is your short side market value, and ideally the maximum long side value, or in other words, the place where you'd want to get out of your longs, okay? Conversely, this is where you want to get out of your short. And at this point, really, you would be looking to get long. You'd be flipping your bias. So it's really important to understand that if you trade price channels like this that go sideways for a considerable amount of time, you've got a very large amount of predictability within that, okay? You can see that it's quite predictable, all this movement like this, okay? You can see that very well, because that's exactly what you've got. And you would expect something like that to continue as a trajectory. It might not go all the way up in one line, like you can see. I mean, rarely, if there's many other weekly levels or monthly levels in the way, that will occur. And that's why you've got this pushback straight off these key MAs, okay? So you could consider getting long, okay? Because you can see you've got some minor support here, straight off from a dip back on your weekly, and then you would be looking to progress back to the upside where you've previously seen that short side price action, so that you can exit your entries and you can flip your bias. And if you're trading with probability like that, you know, it's proven that for the last 10 years, 12 years at least, you would have been profitable so long as your risk was appropriate. Now, you need to make sure that your risk size is not too large, so that you can't trade this sideways market, because it's all well and good having a profitable method or a profitable, repeatable strategy, or something where you've seen it happen for a long time. but it's completely risk dependent, because if your risk is inadequate for that movement, it doesn't matter how predictable the market comes, you're not going to be able to trade it, because you'll be out at a loss, because your size is going to be far too large. So it's really key to have risk management plans and have a full plan set in place so that you can trade things like this and trade the repeatable market. Remember, we're looking for repetition, we're looking for probability, because they come hand in hand together often in financial markets as one system. Thanks for watching. Don't forget to like, share and subscribe and comment. I'll see you in the next one.